What is Basel Pillar 3 market discipline, and why does it matter? Imagine a world where banks are open books, sharing their financial health with everyone. That's what Basel Pillar 3 aims to do. It's part of a bigger plan to make banking safer and more transparent. The Basel Accords are a set of international rules for banks. They have 3 parts. The first part sets minimum capital requirements to cover risks. The second part involves supervisors checking if banks follow the rules. The third part, called Pillar 3, focuses on transparency through disclosures. This means banks must regularly share detailed info about their finances, risks, and how they manage them. Why is this important? When banks share this data, investors, regulators, and the public can see how healthy a bank really is. This transparency encourages banks to keep their risk levels in check and hold enough capital to cover losses. It's like having a report card that everyone can see, pushing banks to be more careful. Banks have to publish both numbers and explanations about their risks and how they handle them. They share details about their assets, liabilities, capital buffers, and risk management strategies. This information helps market participants make smarter decisions. If a bank shows it is well capitalized and manages risks properly, investors are more likely to trust it. Market discipline is what makes this system work. When banks disclose their financial details, investors and other stakeholders can put pressure on them to stay safe and sound. This external pressure acts as a check on banks, reducing the chance of risky behavior. It's a way to keep the entire financial system stable. Regulators like the European Banking Authority and the European Central Bank set standards for what banks must disclose. They also check if banks follow these rules. These efforts make the data more consistent and comparable across different banks. This consistency helps the market see the real picture and prevents false or misleading information. Looking back, the push for more transparency grew after past financial crises. Governments and regulators realized that open sharing of information could prevent future problems. The Basel Accords, especially Pillar 3, have helped build trust in banks and make the financial system more resilient. In the end, Pillar 3 matters because it uses openness as a tool. It encourages banks to be honest about their risks and capital. This openness works alongside rules and supervision to keep banks safe. When banks operate transparently, everyone benefits from a more stable and trustworthy financial system.